Welcome back, dear students and scholars. We have now reached the final video of ASC 323, and today we are turning the full topic into practice. This is where the rules stop sitting politely in separate slides and start appearing together inside exam style questions and case facts. We will work through multiple choice questions, short answers, and one integrated case covering scope, significant influence, journal entries, basis differences, intra entity profit, losses, ownership changes, and tax credit presentation. The goal is not just to know the rules, the goal is to apply them calmly when the fact pattern tries to look more dramatic than it really is. The practice strategy is simple: do not calculate before classifying. First, identify the relationship between investor and investee. Second, choose the model such as ASC 321, ASC 323, or ASC 810. Third, record the relevant entries. Fourth, reconcile the carrying amount. Many wrong answers begin because the learner grabs the calculator too early. The calculator is useful, of course, but it should not be promoted to chief accounting officer. Classification comes first, arithmetic comes after the model is correct. Read ASC 323 facts in a fixed order. Start with ownership percentage because it gives the initial presumption. Then read rights and restrictions such as board seats, standstill agreements, founder control, or access to information. Next, decide whether the facts support control, significant influence, or neither. Only after that should you move to income, dividends, basis differences, losses, impairment, or tax credits. The memory line is important. ASC 323 questions are relationship questions before they are math questions. If you miss the relationship, even perfect math can take you to the wrong answer. MCQ1 tests significant influence below 20%. Ravel acquires 18% of Signal Robotics, receives one board seat, participates in annual budget approval, and supplies key technology used by Signal. Signal is not controlled by Ravel. The question asks for the most appropriate accounting conclusion. Read the facts carefully before choosing. Below 20% does not automatically mean passive, but a board seat alone also does not automatically mean control. Take a moment, read all four choices, and lock your answer before moving to the explanation. The correct answer is B. ASC 323 may apply because significant influence can exist below 20%. Option A is wrong because below 20% does not automatically prevent significant influence when qualitative indicators are strong. Option B is correct because board representation, budget participation, and technology dependency support significant influence. Option C is wrong because a single board seat does not equal control under ASC 810. Option D is wrong because ASC 320 applies to debt securities, not this equity investment fact pattern. The lesson is clear. Percentage starts the analysis, influence facts finish it. MCQ2 tests rebutting significant influence even when ownership is above 20%. Luma owns 25% of Metro Foods voting stock, but a standstill agreement blocks board participation. A founder group controls all policy decisions, and Luma cannot obtain detailed operating information. Luma also does not control Metro Foods. The ownership percentage may look tempting, but the restriction facts are the real battlefield here. Choose the answer that best reflects the relationship, not just the percentage. Lock your answer now. The correct answer is C. Significant influence may be rebutted, so ASC 321 may remain relevant. Option A is wrong because the 20% presumption is rebuttable. Option B is wrong because 25% ownership is not control when the investor lacks power over the investee. Option C is correct because the standstill limits, founder group control, and lack of information access together rebut significant influence. Option D is wrong because ASC 740 deals with income tax accounting, not investment classification. Rights, access, and restrictions can defeat the ownership presumption. Percentages are helpful, but they do not get unlimited authority. MCQ3 tests dividend treatment under the equity method. Meridian owns 40% of Harbor Snacks and applies the equity method. Harbor pays total dividends of $30,000 in 2026. The question asks how Meridian should record its share of the dividend. The key is to remember that equity method dividends are not treated like fresh income. Calculate Meridian's share, then choose the correct debit and credit. Take a moment and choose the entry. The correct answer is B. Meridian debits cash for $12,000 and credits investment in Harbor for $12,000. Option A is wrong because crediting dividend income would double count earnings already recognized through equity pickup. Option B is correct because $30,000 times 40% equals $12,000 and the dividend reduces the investment carrying amount. Option C is wrong because the entry is reversed. Option D is wrong because dividends are recorded, just not as income. Equity method dividends are returns of investment, not new income. MCQ4 tests basis difference amortization. Summit owns 40% of Canyon Robotics. Canyon earns $180,000 in 2026. Summit's basis difference amortization for 2026 is $28,000. The question asks what equity method income Summit should report. First, compute Summit's raw share of Canyon's income, then adjust for the basis difference amortization. This is one of those questions where the numbers are friendly, but only if you put them in the correct order. The correct answer is D, $44,000. Option A, $72,000, is Summit's raw share of Canyon's income before amortization, so it is incomplete. Option B, $28,000, is only the amortization adjustment, not the final equity method income. Option C, $100,000, does not fit the correct calculation. Option D is correct because $180,000 times 40% equals $72,000 and $72,000 minus $28,000 equals $44,000. Start with income pickup, then adjust for the investor's basis. MCQ 5 test intra-entity inventory profit elimination. Pixel Parts sells inventory to Northstar for $100,000. Pixel's cost is $70,000. Northstar owns 40% of Pixel. At year end, 25% of the inventory remains unsold and tax effects are ignored. The question asks what unrealized profit Northstar should eliminate. Do not use the full sale price. Do not use the full profit before applying the unsold portion. Work through the three-step calculation and choose your answer. The correct answer is A, $3,000. Option A is correct because total gross profit is $30,000 calculated as $100,000 minus $70,000. The unsold portion is 25%, so unrealized profit is $7,500. Northstar's investor share is $7,500 times 40%, which equals $3,000. Option B is wrong because $7,500 is before applying investor ownership. Option C is wrong because $30,000 ignores the unsold portion and ownership. Option D is wrong because $100,000 is revenue, not profit. Equity method eliminates only the investor's share of unrealized profit. MCQ 6 tests suspended losses. Orion's equity method investment carrying amount is $90,000. Orion's share of investee loss for 2026 is $120,000. Orion has no guarantees, commitments, loans, advances, or other investments in the investee. The question asks what Orion should report. The key phrase is no additional exposure. Once you see that, the zero floor rule should come into focus. Choose the best answer now. The correct answer is C. Orion recognizes a $90,000 loss and suspends $30,000. Option A is wrong because a negative investment balance is not automatic without additional exposure. Option B is wrong because Orion must recognize losses up to the investment carrying amount before suspension begins. Option C is correct because the $90,000 loss reduces the investment to zero and the remaining $30,000 is suspended. Option D is wrong because the recognized and suspended amounts are reversed. Stop at zero unless the investor has additional loss exposure. MCQ 7 tests a partial sale while significant influence remains. The investor owns 40% of Ridge Motors and the equity method investment carrying amount is $800,000. The investor sells one fourth of its interest for $230,000 and retains significant influence. The question asks for the gain or loss on sale. Focus on the portion sold, not the total investment. Calculate the carrying amount removed, then compare it with proceeds. The correct answer is D, a $30,000 gain. Option A is wrong because $230,000 is the sale proceeds, not the gain. Option B is wrong because $200,000 is the carrying amount of the portion sold, not the gain. Option C is wrong because proceeds differ from carrying amount sold, so a gain or loss must be recognized. Option D is correct because $800,000 times 25% equals $200,000 carrying amount sold, and $230,000 minus $200,000 equals a $30,000 gain. Partial sale gain equals proceeds minus carrying amount sold. MCQ 8 tests the proportional amortization method for qualifying tax credit investments. A qualifying tax credit investment meets the proportional amortization criteria and the investor elects the method. The question asks how the investment amortization and related tax benefits are presented on the income statement. This is a presentation question, not a consolidation question, and not an OCI question. Choose the answer that matches the tax line model. The correct answer is A. Under proportional amortization, both the investment cost amortization and the related tax benefits are presented within income tax expense or benefit. Option B is wrong because gross presentation applies when the investment does not qualify for proportional amortization. Option C is wrong because other comprehensive income is not the presentation model for tax credit investment amortization. Option D is wrong because qualifying for proportional amortization does not trigger consolidation. The memory line is simple. Qualified proportional amortization gives tax line presentation. Now we move to short answer 1. Apex Capital owns 28% of Delta Foods. A standstill agreement blocks board participation. A founder group controls all policy decisions. Apex cannot obtain detailed operating information, and Apex does not control Delta. The task is to write a scope conclusion and give at least two reasons. Do not answer mechanically just because ownership is above 20%. Your conclusion should address the presumption and then use the rebuttal facts. The model answer is that Apex should not automatically apply ASC 323 solely because it owns 28%. The presumption of significant influence is rebuttable. Here, the standstill agreement blocks board participation, the founder group controls all policy decisions, and Apex lacks access to detailed operating information. Those facts rebut significant influence. Therefore, ASC 321 may remain the applicable model if no other standard applies. This is a strong short answer because it gives a conclusion, cites the relevant facts, and identifies the likely alternative model. Short answer 2 tests the basic carrying amount mechanics. Meridian buys 40% of Harbor Snacks for $500,000 on January 2nd, 2026. No basis difference exists. Harbor earns $120,000 and pays $30,000 in dividends during 2026. The task is to calculate equity method income, dividend received, and ending carrying amount. This is the clean equity method engine from video 3. So work in the order: income pickup, dividend, ending balance. The model answer is straightforward. Equity method income equals $120,000 times 40%, which is $48,000. Dividend received equals $30,000 times 40%, which is $12,000. The ending carrying amount is $500,000 plus $48,000 minus $12,000, which equals $536,000. Meridian reports $48,000 of equity method income and a $536,000 ending investment carrying amount. The dividend reduces the investment, it is not new income. That point is small, but it saves many answers. Short answer 3 tests losses at zero and later recovery. The investment carrying amount is $50,000. The investor's share of investee loss is $80,000. The investor has no guarantees, commitments, or other investments. In the next year, the investor's share of investee income is $45,000. The task is to explain the year 1 loss recognition and the next year recovery sequence. This is a great test of whether you really understand suspended losses, not just the journal entry. The model answer is this. In year 1, recognize $50,000 of loss to reduce the investment to zero. The remaining $30,000, calculated as $80,000 minus $50,000, is suspended and tracked off balance sheet. In the next year, the $45,000 share of income first clears the $30,000 suspended loss. Only the excess $15,000 is recognized as new equity method income. So the sequence is recognized loss, suspended loss, recovery of suspended loss, and then income recognition. Suspended losses stand in line before new income. Short answer 4. Test tax credit presentation. The investment qualifies for and elects the proportional amortization method. The facts show no significant influence. Substantially all projected benefits are tax benefits. Tax credits are probable. Projected yield remains positive and liability exposure is limited. The task is to explain the income statement presentation when all criteria are met. This is not about ordinary equity method income. It is about the tax line presentation under the proportional amortization model. The model answer is that when the proportional amortization method is elected and all criteria are met, the investment cost is amortized in proportion to the tax credits and other tax benefits allocated to the investor each period. Both the amortization expense and the related tax benefits are presented within income tax expense or benefit. This creates a net tax line presentation. If the investment does not qualify for proportional amortization, gross presentation applies. Losses appear in pre-tax income and tax benefits appear separately in the income tax line. Now we enter the integrated case. Vertex Manufacturing buys 30% of AeroParts for $660,000 on January 2nd, 2026. Vertex receives one board seat and participates in budget approval. AeroParts has booked net assets of $1,800,000, earns $300,000 in 2026, pays $80,000 of dividends, and reports a $2,500,000 loss in 2027. There is also an inventory step up of $60,000 fully sold in 2026 and an equipment step up of $240,000 with a 6-year remaining useful life. This case is not trying to be scary, it is trying to see whether we can stay organized. The case requirements must be solved in order. First, decide whether ASC 323 applies. Second, record the initial investment. Third, calculate 2026 adjusted equity method income. Fourth, record the 2026 dividend. Fifth, reconcile the 2026 ending carrying amount. Sixth, apply the 2027 loss to zero rule. This order matters. If we jump directly to the final carrying amount, we may miss the classification or basis difference adjustment. Good case answers are like good audit files. The conclusion is much easier to trust when the path is visible. The influence gate supports ASC 323. Vertex owns 30% of AeroParts, which is above the 20% threshold. Vertex also holds one board seat and participates in annual budget approval, which are qualitative indicators of significant influence. Vertex does not control AeroParts because there is no majority voting power or other control facts stated. No rebuttal facts are present. Therefore, Vertex has significant influence without control, and ASC 323 equity method accounting is appropriate from the acquisition date. The initial investment is recorded at cost. Vertex pays $660,000 for the investment. So the entry is debit investment in AeroParts for $660,000 and credit cash for $660,000. This establishes the starting carrying amount. There is no income statement effect at acquisition. All later adjustments for income, dividends, and basis differences build on this starting balance. This is the easy entry, but do not underestimate it. A clean starting point makes the rest of the case much easier. Now record the basic 2026 income and dividend effects. AeroParts earns $300,000 and Vertex owns 30%, so Vertex's share of income is $90,000. The entry is debit investment in AeroParts for $90,000 and credit equity in earnings of AeroParts for $90,000. AeroParts pays dividends of $80,000 and Vertex's share is $24,000. The dividend entry is debit cash for $24,000 and credit investment in AeroParts for $24,000. Again, dividend is not income under the equity method, it reduces the investment. Now adjust income for basis differences. Vertex's book value share is $1,800,000 times 30%, which equals $540,000. The differential is $660,000 minus $540,000, which equals $120,000. Inventory share is $60,000 times 30% or $18,000. Equipment share is $240,000 times 30% or $72,000. Equity method goodwill is $120,000 minus $18,000 minus $72,000, which equals $30,000. The 2026 amortization is $18,000 for inventory plus $12,000 for equipment because $72,000 divided by 6 years equals $12,000. Total amortization is $30,000. So adjusted equity method income is $90,000 minus $30,000, which equals $60,000. Now apply the 2027 loss twist. The 2026 ending carrying amount is $660,000 cost plus $60,000 adjusted income minus $24,000 dividends, which equals $696,000. In 2027, AeroParts reports a $2,500,000 loss. Vertex's 30% share is $750,000. That exceeds the $696,000 carrying amount. Vertex recognizes $696,000 of loss to reduce the investment to zero. The remaining $54,000 is suspended. No negative investment is recorded because Vertex has no guarantees, loans, or other exposures stated in the case. The full case conclusion ties everything together. ASC 323 applies because Vertex has significant influence without control. The initial cost is $660,000. The 2026 adjusted equity method income is $60,000 after $30,000 of basis amortization. The 2026 dividend reduces the investment by $24,000. The 2026 ending carrying amount is $696,000. In 2027, Vertex recognizes $696,000 of loss and suspends $54,000. A complete ASC 323 answer always ends with a reconciled carrying amount. If the final number cannot be traced, the answer is not finished. The final revision board gives us the full memory map. Scope asks whether the investor has common stock or an equity like interest with significant influence but not control. Boundary separates ASC 321, ASC 323, and ASC 810. Core entries are cost, income pickup, and dividends. Adjustments include basis differences, intra-entity unrealized profit, and OCI. Losses stop at zero unless additional exposure exists, and suspended losses must be recovered before new income. Changes include impairment, partial sales, and tax credit structures. The final memory line is the best way to close the topic. Relationship first, accounting model second, reconciliation last. That completes ASC 323, dear students and scholars. We have covered when the equity method applies, how significant influence works, how journal entries are recorded, how basis differences are allocated, how intra entity profit is eliminated, how losses are suspended and recovered, and how impairment, ownership changes, and spatial structures affect the analysis. Next, we move to ASC 325 Investments Other, which continues the broader investment accounting family after ASC 320, ASC 321, and ASC 323. If this practice lab helped you log the topic, please like the video, subscribe to Commerce Regiment, support the channel, and share it with classmates and colleagues who are learning US GAAP seriously. Thank you for studying with focus and discipline. I will see you in ASC 325, where the next investment category begins.